Michael Every is joining us right now. He's head of financial market research at Asia Pacific at Rabobank. He's with us. Michael, thanks very much for your time. Good morning. What's, a simple question, but so all that is wrong with the global economy, no growth, commodity prices crashing, China, all that is known. Is there anything else which is at the root of this market mayhem, financial market mayhem that we are seeing, Michael?
Anything else beyond the fact that we have a massive global oversupply in everything and not enough demand? Yes. The other thing is that up until now, despite the fact that we've had rotten fundamentals for years and years, is that all of us have just relied that somehow central bankers would always provide us with a get-out-of-jail-free card and magically manage to create a policy stance that would save us from our own sins. What we're seeing now is the beginning of the end game, whereby people are realizing that central banks actually are out of ammunition, or that the ammunition that they have left is actually more dangerous than the problem that they're actually trying to fight with it. We've seen the market actually come off its lows this morning, purely because we're getting rumors that the Bank of Japan are actually going to act again already, having only just acted on January 29th by going to negative interest rates. There are market suggestions that they're going to increase QE again significantly, which of course has not worked at all so far, and that they may even go to an even deeper negative interest rate and make FX market intervention. Effectively, it's absolute panic stations if that is completely true, because none of these things have worked so far in any combination, and why we think even more of the same would work, I really don't know. But the market's looking for any reason to try and rally a little bit this morning, and we have seen a little bit of a pickup on the back of that rumor.
Michael, so, many people, including me, didn't understand why this worked for the last many years, right? Growth wasn't there and all of that was very clear. But markets are markets and these things work. Why is it stopped working now, you think? The central bank intervention, liquidity, etc. Why do you think it's not working anymore? It's not as if they don't have ammunition. They have plenty of ammunition. They can do what they want.
Well, it can, but look, to be honest with you, the reason it's worked up until now and it's stopped working is the same thing. If you understand how QE works, effectively it's artificially injecting new credit into an economy that doesn't want it anymore. If you don't have credit going into an economy, you don't have growth. It's as simple as that. And when no one's demanding it organically, QE attempts to try and force it in. The problem is that in order to get QE to work, you need to continually keep escalating it. So if in year one you put in X, in year two, you can't only put in X because therefore you've got no growth in credit. It needs to be X plus a growth factor on top. And then in year three, it needs to be X plus X of the previous years plus another growth factor on top. So in other words, QE has to keep being escalated in order for it to work. And what we're finding is that central banks, like Japan, for example, are running out of government bonds to buy. They're running out of credible assets that they can buy. So the market is looking ahead and seeing that even if there's another few months' worth of assets they can squeeze out, that pretty soon there's just literally nothing more they can buy, which is why we've also seen the shift to negative interest rates. Unfortunately, negative interest rates kill the banking sector for a variety of different reasons. So on top of the fact that the economy is struggling, you now hurt the banking sector too.
No, I'm saying, is that the aspect which has not been focused on that much, which is negative interest rates means banks' net interest margins get hit, right? Why would a bank where margins are lower be inclined to lend more? Is that an aspect which is a huge reason why this is not working?
Oh, absolutely.
Especially the negative rate aspect, yes.
It took the markets a while to understand that QE doesn't do us any favors. It may artificially prop up the equity market, but it doesn't do anything for the real economy. And it took the market a while to realize that. Now the market has realized, much more quickly, because the half-life of these policies is continuing to decline, that actually there's no real benefit from a negative interest rate policy. So if that's all that central banks have got left to offer us, negative interest rates going forward, then the market is really starting to panic, because the people who we're relying on to save us from our sins, as I said, are effectively saying that all we've got left in the bottom of the toolbox is, a broken spanner, half a hammer, and a rusty nail. And they can see that these things are actually more dangerous than they are useful. And so, the end game of how this all plays out is just starting to appear in the market's mind, which is very, very messy.
So there is about $6 trillion of debt globally, which is trading at negative rates, right? Round about that?
I think it's now
Why wouldn't... sorry?
I think it's now 8. So I think the 6 trillion was 2 weeks ago.
Okay, 8. All right, fair enough. Now, why wouldn't finance capital want to buy an asset, an equity asset, whatever, a bank, maybe a well-capitalized bank in some part of the world which is offering 5-6% yield? Why wouldn't they want to do that?
Why wouldn't who want to do that? Sorry, can you say a bit more clearly?
I'm talking about finance capital, funds, and generally finance capital. All kinds of money.
Well, why? Obviously,
markets basically. Why would markets want to?
If you provide to investors an asset that's guaranteed to yield them 5 or 6%, of course they'd want to buy that. But can you tell me where you can find an asset that offers 5 or 6% in real terms rather than nominal terms, and that doesn't have any underlying risk, and that you can get in and out of very, very easily and transparently?
HSBC, Michael, London listed. They've got a large exposure to China, sure. But are we saying that banks are going to go under? I mean, I think 5-6% yield. European banks, much better regulated, more stable lines of funding from central banks. So what are we talking? If we believe that everything is going to go to hell, then of course there's no point doing anything. But the point is that's not the case, is it?
Well, first of all, I'm not going to be misquoted here or slotted into saying that HSBC is going to go under or any banks are going to go under. That's not what I'm saying. But all I will say is that when you look at the dividend yield you're getting on a particular share, that's based on past earnings, not projected future earnings. And you have to start thinking, what are future earnings likely to look like? And that's when we come back to the negative interest rate policy we were discussing earlier, that it's all very well to say we earned 6% last year, but what's it going to look like with a slowing global economy and a negative interest rate? And it's unlikely to be 6%. So yes, there are still far too many question marks hanging over far too many areas for people to feel confident. Now, could you say that selling's perhaps overdone in some areas? Possibly. Markets always tend to rally or run too far in one direction at once and then swing back too far the other way. That's just the way they operate. But the fundamentals are still absolutely horrible, as they have been for a very long period of time. And as I reiterate, the combination of horrible fundamentals and the realization that no one's actually there as an adult to look after you is really terrifying for investors, and I think quite rightly so. We've been far too complacent for far too many years that everything was sorted out in 2008 and 2009. It wasn't. It never was. And that we can just sit there happily getting 5, 10, maybe in some respects even 15% annual returns from equities just by doing nothing, risk-free. It was an absolute illusion. It always was, and that's being exposed now.
Okay. Now, do you have any, at Rabo, do you have any targets on the S&P or any benchmark that you track how much more you think?
I'm not going to set a benchmark. That's certainly not how we operate on the mainstream equity indices. I'd like to underline the fact that Rabo is the world's leading food and agri bank, and that's the area that we focus on most, obviously. And all these financial market volatility, really, we channel that through into looking at what that actually means for the food and agri sector primarily, as well as, of course, the Netherlands. But for the S&P, all the major indices, it's impossible at the moment to set an area where you think, or a target where you think it could get to, because it really depends on the prevailing backdrop. All I can say is that I don't understand where the optimists get their optimism from. Because whatever scenario you paint going forward...
Michael, I don't know who you're talking to, but I don't know who you're talking to. I want to talk to the same optimists as well. Too much negativity here. But I can't find a single optimist.
Okay, well, I'm glad to hear that, and that actually just reinforces my fondness for the Indian market. Actually, you have a great deal of pragmatic, sensible thinkers there. In the US, you still have far too many optimists, I would say, relative to pessimists. And you can see that in the fact that the S&P didn't go down as much yesterday as other markets did, and even tried to rally into the close. But basically, if you look at the most optimistic scenario you have in terms of the global fundamentals, the best scenario you have is that the Fed is right, and that a low unemployment going forward will actually cause wages to go up in the US. Now, I would posit that's not true, and low unemployment is because wages aren't going up, and we've actually got a quasi-third world economy there now where you can employ as many people as you want at very low wages with very low productivity, and I think that's what's happening structurally in the US. But if I'm wrong, and we do see wages start going up in the US, what does that mean? Higher US interest rates, stronger US dollar. How does that help the emerging world? How does it help most of the global economy? It doesn't. It's going to be extremely painful. So that's your best case scenario, massive disruption on that side. And your worst case scenario is that wages don't go up in the US, the recovery falls over, they have to go to a negative interest rate policy too, and we're stuck in a global downward spiral, currency wars, and the whole global framework starts to crumble. That also doesn't look too positive. And on either of those scenarios, I don't rush to buy equities.
Yeah. No good choices, are there? Michael, thanks very much. Good speaking with you. Appreciate you joining in with that perspective. Thank you.